Thanks for joining us today for Berman's Call. We are here to take your questions on stocks and ETFs. Here's how to reach us. Call toll free at 1-855-326-6266. You can email your questions as well. Berman's Call at bnnbloomberg.ca. Larry, good to see you. I believe you sold some of your oil stocks previous to the conflict in Iran, or just about. What was your trigger?
Well, last week we talked in the educational segment about markets pricing in the anticipation of event, and typically on the event, it's a good catalyst to take a profit on that trade. So the energy sector really ramped up in terms of the stocks, a little bit in terms of the underlying commodities, and frankly, when we look back a week, we don't see the energy sector in Canada or the U.S. making higher highs than it did at the opening on Monday. So, proves to be a good call here. How long this lasts and this catalyst for market volatility, it could be weeks. It probably won't be months, but definitely it's longer than, the initial expectation was. Certainly from the U.S. administration. At
what point do you start worrying about inflationary effect?
It's got to be sticky here. I don't think the world adapts well to oil prices. West Texas over $100 a barrel. We've seen examples in the last 15 years where that's been the case. Generally, there's been some economic weakness to follow. But it's something that the average consumer, if it's a month or two of slightly higher gas prices, they can deal with. If it's 6 months, a year of higher gas prices, it starts to eat into other consumption.
Okay, so let's talk about advice overall for investors on a day like today, where we're just over a week into this conflict. Gas prices have spiked. We are not sure how long it's going to go, and there doesn't really seem to be a clear indication of that. So how would you advise investors at this time?
Yeah, if you're a trader and you're on the screens all day, then you can trade the energy stocks in and out, back and forth, and react to the latest headline. But you've got to be watching everything that could come out of the White House. You've got to be watching everything that could come out of the Middle East. And you're competing with some of the trading desks around the planet that do that. So the average investor shouldn't be doing that. The average investor should be taking opportunities like this that does cause market dislocations to look for opportunities that might arise. And I can talk about some of them in the educational part of today's show.
You spoke about sort of energy more in general. Would you do anything different with natural gas versus oil?
Well, natural gas is harder to distribute than crude oil is, given it needs to be liquefied. There's not enough global capacity to do that in an efficient way. So it does tend to matter a little bit more. I think the vast majority of the distribution through the Strait of Hormuz is mostly on the crude oil side. There's less impact on natural gas there. There is some, though.
I also wanted to ask you about the fact that some of the production seems to be ramping down in the Middle East. Reuters reporting Saudi Arabia is now sort of going that route. How long will it take for some of this to ramp back up if and when we get there?
So I think there's probably some, now I'm not an expert in this area, but there's probably some capacity that can be turned off and on easier. So they might be able to slow down production. So instead of that pump driving, 10,000 barrels a day, they might be able to turn it down to 5. And it's not like they're shutting wells off completely. They're just, I think, slowing the production. And so that kind of move can go faster. If you're talking about taking wells off capacity, I don't think anybody's doing that at the moment.
Got it.
I'd be very surprised, just given that these geopolitical events tend to be short-lived and shocking, as opposed to, it's a more permanent capacity constraint.
All right, let's take a quick break. We'll get to the first phone calls and emails when we come back. Here's the phone number again, as well as the email address. If you have a question for Larry Berman on ETFs and large cap stocks. Back in a moment. Welcome back to Berman's Call. We are here with Larry Berman to take your questions. Larry, we'll start with an email here from Andrew. He says, I recently sold my home and I'm seeking a short-term, so 6 to 12-month, low-risk investment solution to preserve capital while earning a competitive return before purchasing another property. What would you recommend? So 6 to 12 months, earning something competitive, Larry.
Yeah, so I would look at perhaps a preferred security, something where you're going to get a tax benefit. It sounds like the money's taxable, given that it's come from the sale of a house and going to purchase a house. So that would be something with a dividend, but a pref. In this case, if you go to a bond, you're going to pay full tax. So the question is, how efficient do you want to be and how safe do you want to be? A pref's going to have, probably that much risk to it, but a little bit more, but it's going to pay you an after-tax yield that's a lot higher than what you could get in a very safe money market instrument at this point. So, you would have to be able to have a source of pref securities and look at and make sure they're not resets. And there's a couple of things you would have to do. So I don't have a specific instrument that I would say, go buy this right now, that's the one for you, because I just don't know enough about the situation. But those are a couple of things that would come to mind. If you're looking to not take any market risk, you don't want to be in equities if you need this money for a house in 6 to 12 months, because that could be a really bad outcome. So you want to shy away from that, but you want to be as tax efficient as possible. So, a pref security is probably going to give you the right kind of after-tax return.
Okay. Let's move on to our first caller then. Andreas is on the line. He's in Calgary. Hi, Andreas.
Hello to the both of you. Larry, I had a question about the potash sector as a whole. We haven't seen much activity from that sector as of recently. And is Mosaic, are they a good way to play it? I'd just like to know your opinion on that. I value your opinion very much. Thank you so much.
Thank you for the question. Let's talk about Mosaic. And I'm also wondering if you have concerns about that same conflict with Iran and affecting some of the fertilizer product that passes through there.
I think there may be some. I think it would be de minimis in that respect. I do love the sector. I believe that the world is growing and we need to enhance our crop yields as much as possible. So I do love the sector. It is very cyclical. A huge part of it relates to what India ends up paying for potash supply in many years. I don't know if you can pull up a 5-year chart here or not of Mosaic, but you need some perspective here, where the stock did really well in 2020 and 2021, and really ever since the peak in early 22 has been going down. But it's making a longer-term bottom formation on this pullback. I like it a lot here. So it's a name we're nibbling on in our portfolios. And I like it here, but analysts a year from now think it's worth $32. So the upside to downside risk return is about balanced. Half a position here makes some sense. If it gets a little bit weaker, you can add to that. But the analysts don't think it's going to run too much more than low 30s at this point a year from now.
Okay. Andreas, I hope that works for you. Let's go to Alfred from Mountain View, California. Hi, Alfred.
Yeah, hi there. Mr. Berman, your thoughts on XDIV ETF. It tracks the S&P 500 index, but it doesn't pay any dividend distributions, making it very tax efficient, which is what I am looking for long term. Thank you.
Thank you for the question. So this is the ETF chart here. It's up 53% over the last year. What do you think of this one?
Yeah, so I'm not sure that same question matches the XDIV ETF here. I think he said X something, but I didn't catch it.
He said it
tracks the
XDIV.
Yeah, he said something that tracks the S&P 500. So we're looking at a basket of Canadian dividend stocks there.
Okay.
And so there's a dislocation there. I'm not sure if we can get him back on the line to clarify or not. But for XDIV, you've had a really good run up because the Canadian banks, insurance companies, and the energy stocks have recently had a really good run. and forward returns are not necessarily what we've seen in the rearview mirror. So I don't love Canada as much right now for pure dividend exposure. If you're talking about the S&P 500, 65, 6,600 as a next support range for the U.S. market is where we'd be nibbling and putting some money to work on the current pullback. So hopefully that might answer either one of those questions.
Just also wondering why you don't like Canada right now for the dividend outlook.
Listen, we've had a great rally in the last year, and so I think it's more fully priced. And it speaks to, what you're paying for something, a year from now today. And I think, pretty richly valued, certainly on the energy side. And I would argue that there's more correction risk in Canada than there is a continuation of that trend at this point.
Got it. Okay. Let's move on to the next caller then. Joe is on the line. He's in Montreal. Hi, Joe.
Hi. I want to ask Larry about these new targeted yield BMO ETFs that have come out, in particular the ZWU, where they say they'll give you a 15% yield. But what I don't understand is just the ZWU itself has only had a return of about 7% in the last 10 years. So in what kind of cases would somebody consider this? I understand you could have a guaranteed yield that you can, if you're budgeting what you want to have in revenue each month, but you obviously miss the upside, just like most covered calls, if the market goes up. So what did you think of these new products, and in particular the ZWU, which is promising 15%? Thank you.
This is a utilities ETF, but Larry, can you explain a little bit more about it?
Yeah, I believe BMO is coming out or is in the process of bringing to market some higher yielding strategies to compete with some of the other players in the Canadian ETF space that have focused much more on the yield return of a portfolio than they have the total return. The ZWU is correct. That ETF, over the long run has delivered 7% plus. If you look at just the basket of underlying stocks over that same period, it would probably be less than that. So you've benefited from the covered call overlay in the ZWU strategy. Some of these newer BMO ones, they're writing closer to the money. They've changed the strategy compared to what's in ZWU into the new one. So I don't believe ZWU is one of the new tickers. I believe there's some newer tickers that are either out in the marketplace or are coming out very soon that are targeted to deliver a lot higher current income. But the caller's correct. It's typically at the expense of growth and capital gains. And what you often see on these is an erosion of the net asset value. BMO tends to do it a little bit better than the others in terms of that net asset value erosion. But we'll see, what they look like compared to the competitive marketplace in the next year or two once we see some experience there.
Got it. Okay, let's get to our next caller, Renata, on the line from Oakville in Ontario. Hi, Renata.
Hi, you both. Larry, your opinion, please, on TELUS. I'm a dividend investor, and needless to say, I bought it because of 9% dividend, but it's doing badly, very badly. What do you think of it? Should I hang on to it and sell it even at a big loss, or should I just get rid of it? Okay, thank you for your opinion. Bye.
Okay, thank you for that question. Go ahead, Larry.
When we get these calls, and whether it's another of the telcos or utilities, pipelines, for the yield seekers out there, I love ZWU. I've been recommending it for years and years, and it gives you the same basket in a diversified way, very tax efficient, an average yield in the last number of years in the 7% plus range. And I just think it's a great tax efficient vehicle for the average investor to get a more diversified exposure, so that whether it's TELUS or another name in that index, BCE has not had a great few years, parent of this network. It diversifies you and get you to that yield and more of a total return approach than sticking with one individual name. So, while it's not a great time to sell TELUS and make that switch, that's something that I've been recommending for a number of years people do.
Okay, let's move to our next caller then. William is on the line. He's in Ottawa. Hi, William.
Hi, how are you?
Good, thanks. Go ahead.
I was wanting to ask Larry what he thinks of the iShare corporate bond is one area I'm invested in. What he thinks of that, how safe is it, and what's his expectation for that? And the other was the Mackenzie fund that I had put some money in and still have it. It's the, hold on, I'll find the thing here. Mackenzie.
Is that the unconstrained bond?
Yeah, that's right.
Okay.
Unconstrained bond fund. Those two investments, I have a fair bit of money in both of them.
Okay, let's start with the Mackenzie. Larry, what can you tell us?
Yeah, I don't want to be alarmist, but I think bonds are going to be a challenge asset class as part of the safe money for clients. Now, don't run out and sell either one of these because it may very well be appropriate for you. But when you look at what the challenges are with government debt in the world, with all the new issuance, with the deficits that governments keep running here in Canada and in the US in particular these days, bonds are going to have a very difficult time delivering a significantly higher return than the cost of inflation. And I'm going to maintain that view until we have a real real return in terms of the fixed income market. You get a little bit higher yield in the corporate than you do in an unconstrained model that's going to have a lot more government exposure in general. But I think bonds are a challenge asset class. This is why in recent years I've said, you should have a look at private credit. Some of these mortgage funds are very, very interesting to give you not the 3 or 4% that you're going to get from a fund like this on average, but something like 6, 7, or 8% that you would get from the private credit markets if you're in a really well-managed fund.
Okay. Let's move to an email here from Peter. He says, Larry, what exposure do Canadian public financials, so banks, life cos, alternative lenders, have to the private credit markets and the liquidity crisis we are seeing there right now? It's kind of a broader question. Larry, can you hammer that down a bit?
Yeah, so here I'm telling people to go into the private credit markets. I think it's going to be way better in the long run, notwithstanding the current noise. Listen, what's gating all these funds and the bad write-ups you hear in the press has everything to do with the average investor who's in them not purely understanding the liquidity constraints around the private credit markets. They're intended for very, very long-term investors not to move in and out. And it's the sole reason why when you see closed-end funds that list publicly trade at a significant discount to NAV, that's what's actually happening right now, where more people want out than in to a lot of these privates because of the news out there, and a lot of people just sell and ask questions later. And I think it's kind of foolish.
Okay, we will leave it there for phone calls and emails, but we will have Larry's educational segment that's coming up next.
Larry Berman is one of Canada's top technical analysts. He's the co-founder and chief investment officer of Q Wealth Partners. To learn more, visit qwealth.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN Bloomberg, its parent company, or affiliates.
Welcome back to Berman's Call. We have Larry Berman with us today, and it's time for his educational segment. Larry, you want to take a look at the effects of the oil prices on travel stocks, that kind of thing. What other stocks are you seeing being dragged down by the rising cost of oil?
Yeah. So, the lens here is that, geopolitical impacts like this are short-lived and we never know when they're going to change. Just a few minutes ago, a headline crossed the tape where Trump said, no, it's not going to be not even 4 or 5 weeks. We're way ahead of that schedule. And all of a sudden, the markets are now trading green on the day where they've been trading red for most of the day. So a lot of these geopolitical impacts are short-lived. And what we should be doing is looking for the areas of dislocation. So when we think about rising oil prices and the negatives, the two sectors that jump to mind to me are sectors where you have big inputs for oil prices. So think airlines, think cruise ships, things like that. Also think about the pocketbook for the consumer. So a consumer discretionary, think clothing. Don't think consumer staples. You got to buy your groceries, but you don't have to buy the new shirt until a few months from now. You can delay those type of purchases. So, and things that are linked to inflation. So companies that have a higher input cost sensitivity in essence. If you look at this chart here, since the beginning of the year, we're looking at the yellow line there, which is the U.S. oil fund. So that's oil prices. And so last week we said the energy sector is not a buy at this point, despite the fact that oil prices can keep going higher. And that's exactly what happened. Oil prices went sideways, and all of a sudden you could see a social media post like we just saw, and markets can really move. And for the average investor, that's tough. The next graph here looks at, again, in the last week, we've blown this up here, and we've put in green at the top the USO ETF that represents the front month crude oil contracts. And we put the 30-year bond, which is down 2% in the week, and then VF Corp, again, consumer discretionaries, American Airlines, Carnival Corp. These are down from 10 to 20% in the last week, while oil prices have shot up. So if you're looking for things to buy where there's dislocations, these are some of the areas that you want to put on your front burner. Don't go out and run out and buy these names all today. I haven't bought them yet. I'm writing options to generate income, and I'm looking to buy them should this extend for a couple more weeks and these stocks get a little bit cheaper.
Okay, and are you sort of picking them up in bits and pieces after that, or what's your strategy here?
The street term is accumulation mode. We're looking at, we don't know, nobody knows how low it's going to go or how long it's going to last. I don't even think the White House knows that. So as they get cheaper relative to everything else, that's when you want to be accumulating them, not when they're getting strong and everybody's euphoric.
Got it. All right, Larry Berman, sir, got to leave it there. Thanks so much for joining us today. And if you want to connect with Larry, you have a few options to do that, from YouTube to LinkedIn, as well as the website, qwealth.com. That does it for the show today. Thanks for joining us. The close is coming up next.